Start.
Hello, good evening, everyone. Thank you for joining today's sessions. I think we will try to cover options, the concept of an options. And from a concept of option, we would also go, how do we do a trading in an option? How do we strategize using an options to our stocks as well? How can we make a different strategies using a call options and a put options? This today's call is only for an education purpose. Uh, Everyone should do their due diligence before making any purchase and sale and any transactions into the actual trading. Okay, so let's keep this only for an education purpose. So if everybody knows, we have a two options. The concept option itself says that it is not a mandatory thing. That means we just have an option. It's not an obligation for us. That's the concept of an option. So we technically have two sets of an options, what we call it as a call options and a put options. So let me just write that down. So we have a call options, and I don't know, it's too small. Let me just increase that. Don't say, okay, so we have a call option. This is call, and then we have put options. Okay, so let's talk about the call options. The call options simply talks about a right to purchase. Imagine, and I'm just trying to use a very simple examples. Imagine that we all are like seeing the farming what we are here. Imagine a simple crop. We will take an apple, for example. An apple's price in today's market is say $2 per pound, and you expect basically the apple price to maybe go up, maybe $3 or maybe $4. Okay, and so what you're doing is you're going to the farmer and you're telling a farmer, okay, you know what, I'm ready to buy your apple after 2 months for a $3. And the farmer says, okay, good. But today a farmer can go to the open market and sell his apple within $2. But after 2 months, somebody is willing to buy his apple for $3. And what they are entering into an agreement, they both are entering into an agreement that a farmer basically is ready to give those apple to the buyer. So he is obligated to give the apple at $3, while the person who wants to buy the apple has an option to buy the apple at $3. So after 2 months, the price of an apple goes to $4. And this guy came in and say, hey, we agreed that you wanted to give me an option, apple at $3. And that's how he got his apple at $3. And this guy sold the apple at the $3, even though the open market price was $4, basically. Now, why do they enter into this contract? Because the buyer expecting that the price would have gone up, and a seller was thinking that maybe he's not sure where the price would be. So that's what the buyer paid him, like a 20 cents, if you ask me, just as a call price. And a seller kept that 20 cents with him and eventually sold the apple to him after 2 months for $3. So from a seller's perspective, what he got $3.20. If you ask me, 20 cents he got it when he entered into a contract, and he sold the apple for $3. So his total realization on selling the apple was $3.20. While the guy who bought the apple, he bought the apple for $3.2, and the market price for apple was a $4. So difference between 3.2 and a $4, 80 cents is what this guy has made a profit, the one who was buying it, basically. So this is the price, $4. This is $3.2. Sorry, this is too large a font. I'll just small it out. And that's how we basically made a money. So what I'm trying to tell you is, in a call option, you are basically buying a right of purchase. Very important. Now, call is purchase. That's what you should remember. And put means sales. That's what you should remember. let me just do it here. This is purchase. Okay. 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 And this is sale. Now, what I want you to remember is the call option. Basically, when you're trying to buy a purchase, right of purchase, you can also, this is very confusing. This is going to get confusing. This is also going to be a right of, you are going to buy a right to purchase a stock, or you're also going to basically sell a purchase right. So you can basically technically do a buy and a sell into the call options. Likewise, in the put options, you can also do a buy and a sell. So you can buy a put option, or you can sell a put option. So let me take an example of a stock rather than basically taking. So we all know the share price of, say, take an example of a Microsoft. So Microsoft share price today is 408. Very simple. This is current market price. We call it as a CMP. Okay, let's take an example of a call options. What is a call options? How we can basically do a call options for Microsoft. Now, three things are important for call options. First is you need to think through what do you expect the Microsoft share to be. It's very, very important. There has to be a thought in your mind that either you expect it to go up, either you expect it to go down. So you would basically purchase a call option when you expect the share price to go up. Now, if you, and second important thing is you need to define that horizon. How much is an horizon you expect that the price will go up? For example, today we are on a 15th of February, and I expect that Microsoft price of 408, it would be, let's assume 425, but by say end of imagine 28th of February. Very simple. So my target price, I am thinking my target price is 425 basically at the end of 28th February. Let's put this 28th Feb. Now I have two options. If you see this, what I can do it is I can buy 100 shares of a Microsoft today on 15th of February, which is going to cost me $40,800, 100 shares. And that $40,800 would pay me, imagine that on February 28th, the price went to 425. You are imagining, but reality that happens on 28th February, it's your stock. So you have earned basically a profit of $17. So $17 into 100. So your profit is going to be $1,700. This is going to be your profit on the stock. Now, to get the 1,700 profit, you actually invested 40,800. Okay, so I want to repeat what we were trying to do. We were trying to define two things. We thought that the share price of a Microsoft will go up. That's our first thought. And then we thought that it will go up to 425 by 28th of February. These assumptions are most important when you are doing a call or a put options. So on 28th of February, this price could be anything, and we'll come to that scenario. But I'm just trying to tell you what is a cash purchase versus a call purchase. So for a cash purchase, you will spend 40,800, and if the price goes to 425, you will make $1,700. So on a 40,800, if you see $1,700, that approximately comes to maybe I would say 4% gain what you would make basically. So you're actually making an investment of 40,800, and you would make a 4% gain on your investment by end of 28th February. Now let's look at the same scenario, and we're going to do this by way of an option. So now which option I should buy, a call option or put option? Very simple rule. When you expect a share price to go up, you should buy a call option. Okay, so you're expecting it to go up, so you're going to buy right of purchase that share. You're not going to actually purchase it. because you're expecting the share price to go up. Now let's look at the same scenario. We're going to do it. So what happens is today on 15th February, me and Anil ji comes into the contract. Imagine Robinhood and me. So Anil ji is on a seller side and I'm on a buying side. So I'm going to buy a basically an Microsoft call options. So what Anil ji told me, okay, Hitesh, you can buy basically Microsoft shares from me at 425 on 28th of Feb. So now I expect the price to go up to 425. The current market price is 408. Now the difference between these two is $17. If I need to earn $17, I can buy a call option which has to be below 425 for sure. Now, if you buy, so what do you mean by you need to buy a strike price? So when you buy a call option, you need to tell Anil, I'm going to tell Anil, I'm going to buy on 28th February 100 shares of Microsoft from you. Then Anil is asking, at what price do you want to buy? I can tell that, okay, I want to buy it at, for example, I'm going to buy this at 410. Okay, what is my current market price? My current market price is 408. What I expect the future market price to be, this is my future market price. So what is my potential profit? I'm talking about $17. But I decided, okay, I don't want to buy basically call option of 408. I'm saying, Anilji, give me a 100 shares of Microsoft at $410 basically at on 20th of February. Now, if imagine what Anil is not going to give me this right for free of cost. So Anil said, okay, Hitesh, the current price itself is 408. You want to buy at 410. I'm going to charge you $1. So you pay me upfront $1 and I will keep that $1, whether the share price goes up or not. And I guarantee you that I would be giving you $100 on 28th of February if the price is at 410 or above 410. So Anilji is obligated to give me the 100 shares delivery on 28th of February if the price hits to 410 or above 410. So so I paid $1 to Anilji. So my investment is exactly $1. Imagine there are going to be two scenarios. When I say two scenarios, the price goes to 410 and above, or price, imagine it goes to 425. If it goes to 425, what has happened is basically I have made a $15 profit. That means Anilji gave me on 28th February a share, 100 shares at 410. I paid them $41,000 on 28th February. During 15th Feb to 28th of February, my investment was only $1 into 100 share, which is $100. So on $100, I made a profit of $1,500. Basically, imagine like this. So this was my investment. I paid $100 to Anilji. Anilji gave me the shares, 100 shares on 28th of February, and I made a $1,500 profit. Now the same scenario, we are going to basically look at it in a different way. I'm not going to save this. Imagine that I'm going to keep the current market price as the same, which is 408. And imagine the share price on 28th February, you are expecting this to be 425, basically. Okay, this is 425. Imagine I gave Anilji $1. He earned $1 very easily. But the share price on 28th February basically gone, and the strike price was 410, because this is our agreement. We have three essential things on an agreement. One is the date on which he is going to give me the shares, the strike price at which he is going to give me the shares, and the price which we are agreeing for that contract. So there are three important things. So 410, he agreed me, but in reality, the share price becomes 409 on 28th of February. So what happened is this agreement on 28th February is going to get expired because Anilji is not obligated to pay him the shares because the price does not cross 410. Anilji is at the profit. He keeps $1, basically. And I would be at a loss because I lost $1. The share price didn't win. But look, I'm not holding the shares, nothing. I just put $1 as in basically investment because I was expecting it to go up 425, and I had a 28th February horizon. And that's really the concept of a call option. When I'm buying a call option, very important. I want to take a pause. If you all have any questions on how do you buy a call option?
So basically, we buy from Robinhood or we buy this call option for whatever tool we have, right? The Webbull or
Yes.
Robinhood, right? Yep.
Yes.
Okay. And depend on what is the strike. What even by strike rate? Suppose uh, I got a bid option of 20 cents or 30 cents or whatever, $1, and I'm buying 100, not 100, 100, one contract is equal to 100 shares, right? So I'm
Correct.
putting $100 basically.
Correct.
So, so a strike basically means on the rate is being executed, right?
So strike price is where both parties are agreeing a particular price at which they will exchange the share on a certain date. In this scenario, Anil ji and me agreed that we are agreeing to exchange share if the price goes above 410, basically then only. And I can choose any strike price. There are various strike prices available. 410, 11, 12, 13, whichever. See, because
Yeah.
imagine when I'm assuming 410, I believe that I'm going to make $15 profit and I'm going to invest $1. So my net profit is going to be $14. Whereas when Anilji is selling this contract, he is expecting reverse way. He thinks that price is not going to cross 410 and he's going to make $1 profit, 100% keep it.
So
So both,
basically, strike means there are multiple options you can choose, and whenever a contract is executed, that is called strike price agreement, right?
that's right. So you will have that strike price. Now there are more complex scenarios, but I want to first simplify that whether you understand how to buy a call option. You buy a call option, very important. You buy a call option when you expect the price to go up. Very, very important. So if conceptually you are out clear, I'm still going to stay on a call option because once you understand the concept of a call option, whether it's a put option, whether you're selling or buying an option, what do you do, or everything you will understand. But I want you to understand this first. What is an option?
Yeah, basically, yeah. Call means buy, right? Not sell. Put means sell, right?
Call means a right of purchase.
Right,
Very
of purchase,
important.
yeah. Yeah.
And put means right of sale. Now you have to, this is again very confusing. The right of purchase, you can buy it also and sell it also. And right of sale, you can buy it also and sell it also. So there are four scenarios. When call is there, because when me and Anilji are trading a call option, Anilji is also trading on call option. I am also trading in call option, but I am buying a call option. Anilji is selling a call option. So whenever, one rule, whenever you are selling any option, whether call or put, you are obligated. Whenever you are buying an options, you are not obligated. You can buy a call option, you can buy a put option. But when you sell a call option, when you sell a put option, you're obligated by that contract.
Right. So basically, in this case, Anilji basically wins the Robinhood tool, right?
That's right. Anilji is a Robinhood in this scenario, that
That's
he's
right.
obligated to give me 100 shares, no matter
Yeah.
what
Yeah.
happens in the world.
Yeah.
Okay.
You
He
can,
has to give me 100 shares at 410. He's obligated because he's selling the call option to me.
right. And one last question I have that. Suppose today I bought my contract got executed on the rate of 410. Yeah. My strike price was $2 per share, per $2. So basically I have invested $200. And suppose on the 20th, 27th of February, I can see that the stock price going down, like 410 it become 404. So what can we do to keep uh, the loss basically protected? Is there a way?
That $2, that contract, you are allowed to swap the contract. So basically, there are two ways to close the contract. Either
Mhm.
you wait on 28th February, the contract to complete and executed or not executed, correct?
Mhm.
Based on
Mhm.
strike price. Or you can sell the contract again in the open market and come out of it. So if I basically take your example, just let's take your example, what you're saying.
Mhm.
Okay. So you said, okay, 408 is fine, 425 is what we are expecting. So
Yeah.
you bought this for $2 and
Yeah.
this is on 28th February. But what
Yeah.
happens is this 28th February to 15th Feb, we are talking about a trading sessions of 15 days. Maybe if I
Right.
go to the calendar, we are talking about, say, imagine for discussion purpose, these are 10 trading sessions.
Mhm.
Okay. So in a simple maths, what you're doing is you are renting a right. You are renting a right for 10 trading sessions for $2. So every day the trading session comes in, your options value is going to go to 1.8, 1.6, 1.4,
Mhm.
20
Yeah.
cents per day for a simple max. So on 27th Feb, what could happen is what $2 you already lost, maybe it could be worth 20 cents on that day. Sell it and at least save, because you know it's not going to hit 425 or 410, what a strike price you agreed. Sell that contract and come out of it. So
basic-
basically, when you're paying a right of purchase, you are actually renting a right for 10 basically trading days for $2. And every day your contract value is going to get diminished, like your depreciation on a car. When you buy a brand new, that's how it get depreciated. That's how the call options would be.
Oh, okay, I got it now. It's basically
That's what we call as a premium dilution. So you are paying $2 premium, and that's going to get diluted because you rented that right only for 10 days. Very simple.
right. Suppose I bought on the today on the 17th of February, I can see the price went up. I can sell
Perfect.
upfront. I can sell upfront, right? Before
Correct. So
even waiting.
this, yeah, so this $2 in that scenario could be $3. You feel I'm going to already making a $1. Why should I wait till 20th February? Let me sell it, take a $1. So you invested $200, you got $300 back, and you come out of it.
Yeah. And the last question I have that suppose it went 390 and I can see that it's all going to be down. Is there a way? Basically, I'm trying to say that whatever the price I purchased, I don't want to lose the money, a $1 money. So, is there a possibility there, something like that?
No, because see, the basic presumption, the three things what I told you is,
Mm.
first, you assume that price will go up.
Mhm.
Second, you assume the period in which it is going to go up. Third, you assume that what strike price you are comfortable, that from there you should start your profit. If the in these three, if you see the period, then count your trading session and look at your cost. That's your carrying cost, and that's your rent cost, if in a simplistic way. And every day is going to get diluted. So if your share price is going to go up, your chances of hitting your assumption is going to go down and down and down. So that as depreciation is going to be much faster. You'll start losing more money because your basic fundamental is basically challenged. Your fundamental was you expect price to go up, it's not going up, so your contract price is going to go down. On the contrary, Anil ji made upfront $2, he'll be happy because he's praying the price to go down.
Thank you so much. It helped. Yeah, I really appreciate it.
Any other question? So I'm going to make
this question.
go
So
ahead.
if he puts stop loss, right? So can he not like lose any money, or you have to lose little bit? I mean,
No,
not.
stop loss is a concept, you can put it in the stock. Stop loss is not a concept, you can put it in a basically options.
Okay.
Options order are only valid for 24 hours, or maybe not even 24 hours, it's only up to 3 o'clock. So every day you have to put an order fresh, and that's how you can protect it. That's it. There's no other way for you.
Got it.
Okay. Now I'm going to touch upon what is basically a strike price. You know, this is a very important concept.
Can you repeat that? How to protect? Can you one more time, please?
Okay. So if you enter a call options at $2, you every day you can come and you can sell your call as well for say 2.2, 2.4, 2.5. So if it hits to that price, it will get covered. But you want to just protect it, okay? Like, oh, if it goes $1.8, come out of it. That is not possible in the options. What you can do is you can straightway put one order. Oh, if it hits 1.8, just come out of it. But that order has to be put every day, because call options or put options, any orders are valid only till 3 o'clock every day.
Thank you.
Okay. Now let's take an example. We're going to continue the example of Microsoft.
I want to add one thing. So we can have GTC option, right? Good till cancel, even for options. I don't know if
Okay.
Robin will provide that, but other brokers have that.
Okay, maybe Anilji. Okay, so yeah, we can research this little bit and send it on the group. What is that price? Robinhood for sure
Good
doesn't
till
provide that.
cancel is, I think I have that
Okay.
in Think or Swim. That's Charles Schwab, and Interactive Broker also. So they both provide
Okay.
that.
That's good.
Yeah, RH also has that option. Thank you.
Okay, so let's talk about the strike price, and it's very important. And the strike price is basically a price at which both the parties are agreeing to execute the exchange of the share. Okay, and we're going to continue our example of Microsoft 408 current market price. This is what we call it as a Microsoft current market price 408. Now, the strike price and your target price, and I'm just going to put the target price here. This is my target price. I want everybody to remember 425. Okay. Sorry, I'm writing it in the corner. I don't have a pencil. That's what I'm writing by hand. So now the strike price, you have to have a strike price which is less than 425 because you want to make money. You believe that today price is 408. The price can go to 425 or maybe above that. So definitely you want to have a strike price which is basically something you think in your mind probably is going to go and hit. Now what happens is your current market price decides whether you are in money and out of money. I'm going to touch upon two concepts: in money call option, out of money call option. So what is in money call option and out of money call option? And I go back to this old basically trade. So Anil ji and me decided, okay, that okay, 28th February, Anil ji, you gave me a Microsoft at $400. Imagine. So Anil ji is saying, okay, Hitesh, I can give you $400 for in the Microsoft at $400, but today price itself is basically 408. That means on a day zero, when you both are entering in a contract, the person who is having this contract, like me, is already in $8 profit. So what Anil is going to tell me, oh, Hitesh, you need to pay me $11. Let's take an example of he's asking, no, maybe we take a $10. So Anil is telling me, Hitesh, you pay me $10 for this ride. Why Anil is charging me so high as compared to $2? Because the strike price, this is my strike price, $400, is in money. That means on day zero, it is already in profit of $8 because the current market price is 408 and I am buying a right to buy Microsoft share at 400. So obviously Anil is not going to give away his $8 profit. He's going to charge me that back. On the top of it, he's charging me $2 premium. So now you will ask me, then what's an advantage of buying an in money call? There are different strategies. We'll talk when we talk about the strategy, but one of the important strategy is when the stocks are basically non-volatile, or when you want to sell the premiums, you want to sell the premium in money. Like when Anilji is actually selling, he's actually getting $10. Even though tomorrow price goes down to 405, he's actually protected. So it's a different strategy we'll talk about. So there are, when you're selling your calls, technically you want to sell the calls which are in money. So you protect the downside up to one extent, and you also earn upfront money, maybe $2 in this case, Anil earn it. So let's come back to the buyer's perspective. So $400 strike price is called in money call. Now, if I take 410, which was in our case, it is called out of money call option. That means what is out of money? The current market price. If the strike price is more than current market price, then mean you are out of money. That means you are not in profit the day you are entering in a contract. So your premium in this case maybe could be maybe $2.2 or maybe $1.9, not even $1.8 basic. That's how it could be. So any questions on in money call and out of money call? We're still on a call option. We're not even gone to the put option. You can buy a call option for 350. You can buy a call option for 330. It doesn't matter. But you will always see that the more the volumes basically is out of money call, and that too for a short duration. When you go on a long calls, you can look at these strike price when you're so sure about investing. And when we talk strategy, we'll do it really. This is not the best way for me to explain, but conceptually, this is what the strike price. You can buy in money and you can buy out of money. If you buy in money, your charge is going to be upfront profit, which is current market price minus strike price is your upfront profit plus the premium on the top of it, which is like in this case, 8 plus 2. And in this case, there is no premium, is only 1.8. Clear on in money and out of money? Any question? Okay. Okay, let's go to put options. Okay, we're going to go to put options. Put options are basically a right to sell. This is called our right to sell. Okay. Now, what is a right to sell? And I'm going to do it this little differently. And generally, the put options are actually an insurance policy. Is a simply all hedge funds and everyone, when they buy the large quantities of the stock, they always use a put options. So we're going to take an example of our Microsoft share 408. I bought, let's assume Microsoft 5,000 shares. Imagine what I'm investing. So when I'm buying of 5,000 shares, I'm actually putting $2 million on Microsoft. And that's how the big player plays with the big monies. So what they do, they says, okay, I'm putting $2 million, but I don't want to take risk $2 million. What I want to do it is I want to take an insurance, and I'm going to use this word insurance. I want to insure my stock at 405. If the price goes below 405, I should not be incurring any losses. I should get my money back, basically 5,000 into 405. Yes, I would incur $3 of loss because I bought the shares at 408, and maybe at 28th February, the price, even it's a 380, 370, 360, I don't care because I already bought a right or an insurance policy at 405. So how much did I pay? Maybe I paid $2 extra for this cost. So if you see, my loss in this scenario is $5,000 into $3, which is I lost it 408 to 405. I lost $3, and plus I paid $2 upfront. So my total loss is $5. So $5 into 5,000 is basically what I lost, which is $25,000. But by doing so, I protected my $2 million of an investment in a Microsoft. That is what the put is all about. You are actually protecting your downside. I am buying a right to sell my stock at certain strike price. In this example, I bought a right to sell Microsoft share on 28th February at $405, for which I paid $2 upfront premium. So now, can you play an option by itself? You can, basically, but most of the traders use this as an insurance, as a protection. It's like going in a rain with an umbrella. That's how I always say, guys, use your put option when you have a large quantities of the playbooks. And that's how I personally do. I would invest into the huge stock for 1 week. I'll take a put. I will not take the risk and go forward. If even the strike, the price of the share goes from 408 to like 411, $3, I'm making 5,000 into $3, $15,000. I'll make it and come out of it immediately. I'm not worried about it and it's a peace of mind. I'm sleeping very peacefully because I don't care even tomorrow the market crashes, because even though Microsoft hit to 380, 350, 330, I don't care. 405, I'm protected. I paid $2 upfront.
So
That's called put option.
This insurance, how can you purchase? Basically, suppose you bought the put options. Is there options there to purchase the insurance or what?
That's right. You're just buying a put option. I'm using the word insurance, but put option is basically protecting your downside. That's how it is. Now, there are two ways you're doing it. You have the shares, then only you're buying a put options. Doesn't matter. Both are separate things. That means you're protecting your shares, but that's going to be in the multiples of 100 shares. Or you can just buy the put options. Why do you buy the put options? Because tomorrow you feel, and I will go back to basically the old call option. But before I go there, I want everybody to understand the put option is the best strategy. If you have a large quantities of the stock, they are in 100 multiples. Guys, I encourage, if markets are going to be volatile, take a put option. And this is how basically you can protect your investment. That's how conceptually it works. You have a stock, you're buying a put option, protecting a downside. Now you can also buy a put option without a stock, and I'll come to it in a while. But any questions before that? Everybody understand what I'm buying? I am buying right to sell a stock. Whether I have a stock or I don't have a stock doesn't matter. You are buying a right. It's an optional for you. That you're saying, okay, Anilji, I'm going to sell 5,000 shares of Microsoft at 405. You will buy it. That's how it is. Any question?
So this is what the covered thing it is
No, it is not a covered thing. Covered things are totally different.
different.
That's what I'm just still at the concept level. It's
Okay.
a very complex subject, honestly. Options, I want to go very step by step, understand the concept. Then basically what's a covered call, in-money call, what's a dilution and everything. It's a very complex subject, and best way to do it is I log it into the Robinhood and show you guys, because
Yeah,
And
that would be awesome.
right now just
Hmm.
right now understand the concept. It's very important.
so Hiresh bhai,
So
you
I have
the Greeks also.
Sorry, go ahead, someone has a question.
so I have a question about the validity, like period, right?
Mhm.
So as you said, put is valid up to 3 o'clock every day, or there is a more than that, you can expand more for the future time, like a week or a month or so for the put calls.
So you can buy put for any period of time. You can buy a put for maybe 1 year, 2 year, doesn't matter. The strike price is going to be, sorry, the carrying cost is going to be higher. That means, for example, in this scenario, the $2 was basically the cost. Why the cost is only $2? Because the spread is only $3 when you bought the contract. The timeline is only 10 trading sessions. Tomorrow, in your thought, you want to protect your share up to 31st of December. And I'm going to take the same example. Imagine that you want to protect up to 31st of December. Okay. I'm just talking to you from a costing perspective now. Earlier, your cost was $2 on 28th February. Okay. How many trading sessions we were talking about? 10 trading sessions. That's what the cost was, very high. Now, if you want to go on 31st December and you want to protect 405, I can tell you what is the normal cost of capital in the United States right now is approximately, if you take 10 years bond and 2 years bond, it's a $4.5, 4.5% to 5%. So your cost is at least going to be 7%. I'm telling you a simple maths. So if you're going to buy a put options after up to 1 year, that means you're buying an insurance for 1 year, 7% of $400, approximately $28 will be your price. Simple maths, I'm telling you, as compared to $2. So you can buy, but if you're going to spend 7% to protect it, and if the share does not grow up beyond maybe 20%, you're not going to make money. You're losing money. Make sense? So just to
Yes.
answer,
So what happens, say, you said my validity, say, for example, up to like a month, but I realize that I want to sell it before that for whatever, like if market goes up, or say the period expired, but I don't want to get rid of that one. So how does that apply? Like, do I have to execute the put option, or how does that get diluted, or I get
you
like a
you
contract gets over?
okay, so you are buying the option. As I said earlier, whenever you're buying a call option, put options, you are not obligated. You will only exercise your right when you are in profit. For example, take an example of 28th February. If the share price of the stock is $415, you are right at 405. Why would you exercise that? That's gone. You can sell in the open market for 415 and be happy. You bought at 408, you sell at 415, you protected your $2 with a $2 405, which is gone. That's okay, but you are not obligated. But if the share price is $400, obviously you will go and say that, oh, I want to sell my share at 405 because you are in a $5 profit. So you will exercise your right when you are in a profit. So when you are in profit, when in the put option with the current market price of a stock is less than your strike price, and in a call option, the current market price is more than your strike price. That's how it works. Okay, so don't buy put options basically for a longer period unless you feel that the stock growth is going to be so high. Because this is what I do, a simple maths, being a finance guy. is you need to understand your cost of capital is 5%. That means a money you keep it in the fixed deposit will still earn you 5%. Robinhood itself pays the 4% to you. So simple math is 5% you're going to make it. Your normal rate of return on a stock has to be at least in a good stock has to be around 12 to 15%. So in a give and take scenario, you need to make 20% profit. So if you want to make a 20% profit, your carrying cost should be on the top of it. So if your carrying cost is 5%, that means this option cost is 5%, that you want stock to grow by 25%, then only you make 20% profit. You know, it's a complex. So understand this concept. I want you to understand the concept, put and call. Use a call option when you expect the share price to go up. Use the put option when you expect the share price to go down. And these are only purchase things I'm talking about. Selling an option is the risky affair. I always recommend people not to do it because they are called in technical terms naked options, you know, basically, because the loss is unlimited. Tomorrow, basically look at a example of a Sprint share. In one day, the Sprint share went down from $15 to $5. Many people who sold the option for like 30 cents for $14 were thrown out of the market overnight. Very risky. Never ever sell an option. Being a small investor or even a medium investor, I would say always use option to protect your investment, or you can always buy a call option to leverage your capital.
Hitesh bro, one question. Can you show the screen if possible? So some newcomers, they will understand how the call option or put option, right? Basically stock.
Yeah, I think that's
Yes.
what I was saying. If somebody can,
Yeah, if it is a painter, they can't understand what is a call, what is a put. That's a difficult. Some people, newcomers, definitely.
I know, but what I'm saying is if anybody can log in to
Okay.
Robinhood account and share on a screen, and I can guide, and then probably we can take one live example. That will be really helpful if somebody can volunteer. Unfortunately, I reset my password. I still don't got it. I still didn't receive it anything from Robinhood to basically reset on my screen.
Let me try. Give me a few minutes to log on web. This is Satish.
Hey, Hitesh.
Mhm.
This is Sunil. I think the confusion for people might be coming from, when they can exercise the
Sorry, Sunil,
options.
can
Yeah,
you?
I can share my screen through phone, Robinhood.
Yeah, go ahead. Go ahead.
You can go to the Yahoo Finance and you can the chain too. It's much more easier. Do you want me to do that one?
I can go to Yahoo Finance. You tell me where I need to go.
Okay, yeah, just go to the Yahoo Finance.
Okay, I'm at the Yahoo Finance. Okay.
Yeah, and just type the ticker, whatever you want to do it, like SPY.
Let's take a one non-volatile stock. I'm going to take RTX. Let's take RTX. Okay.
Did you find the stock? RDX?
Yeah, it's here. It's here. But how do I look at the options here?
Okay, let me just.
Left side there is options, Hitesh. Come down below analysis. Below analysis.
Yeah, that's an option. Okay, good.
So you can.
Okay, this is a good example. Okay, we can pick it up from here. Okay, I don't know how many people are which stock everyone wants to take it. Everybody knows about it. Like
Microsoft or something.
I
Take
think
SPY.
it's best.
Yes.
take
One is faster, I think, in option market.
a non-volatile stock for you to understand first the call option, because volatility is going to kill the costing. I'm telling you, just take any non-volatile. We can take Walmart, Johnson & Johnson, RTX, Rethon. These are all non-volatile.
Pick IWM.
Which one?
IWM.
IWM. This is like a ETF. Yeah, let's not go. Let's go to Walmart. Everybody understand Walmart. Okay, let's go to Walmart. Very simple. Okay, guys, let's imagine we will continue the scenario. What is the Walmart price today? And I'm going to really do it as if I am thinking, okay, and just try to correlate. 4104 Walmart as a result on Thursday, and 4104 is the price. Now, when you expect a result on Thursday, maybe this is very very short duration of the call. So let's assume on the result you expect the price to maybe go up. Maybe what do you expect? Say 1110. So you expect a 6 rupees price increase on the Walmart. So what you're going to do it is you can buy shares of 104 right now, wait for Walmart price to go up to 110, make a $6 profit. So your return on investment is going to be $6 on 104. Instead, you went to the options and you saw, okay, when is the Walmart? These are the strike price. Where are the let me just take the strike price. These are the strike price, what you see here. Okay, I'm going to go to the options, and let me just see here. Okay. Okay, I'm going to go to, because the current price is 104. These are all, if you see this color, they are all in money calls. Why in money? Because the current price is 104. Anything below that, they're already in profit. You see what I'm saying? So this 2.73, 2.7, 2.75, this is the price. So I expect the price to go up to 110. So maybe I want to make a profit. So how much profit I want to make? Maybe I want to make $2 profit. If I want to make $2 profit, I'm going to focus on 108 as the strike price. So I am buying an option basically for 108. Now for when I'm buying the 108, I need to decide the strike price, the period. Now, if you see this one, this is a Walmart February 25th, February 2028, 108 call options. And this is on, I believe, 21st February. Let's assume that this is 21st February, guys. Okay. So what we are saying is you are going to buy a call option. Again, I am expecting price to go to 110. I want to make $2 profit. Current market price is 104. So I am buying an out of money call, which is at 108. So 1.21 is what I'm paying. Now, guys, imagine for making $2, I have to invest 1.21. That's really a bad call, if you ask me, basically. But what's going to happen is, if the price goes of Walmart on 21st of February to 115, imagine 115. So you would literally make $115 minus 108, which is $7 profit, and you would have paid upfront 1.21. So 7 minus 1.21, that's going to give you a $5.79 profit on an investment of $1.21. That's how basically this call options reflects. Now, and this is very interesting concept. You can see how price of the call option has gone down from 1.5 to 1.5. This is what I was talking about, depreciation. When the stock price was actually non-volatile or maybe just not moving, your premiums are going to get diluted. You're going to lose money, basically, because the stock remains the same. When you see the stock volatility, then only you're going to make money on the call options in either of on the upward side, basically. So this is the best example. 1.21, you're buying a 108 call options. That's how it is. You understand this?
So if it hits 108, then no profit, no loss.
That's right. You lost money of 1.21. You are paying upfront 1.21.
Okay.
Why you are paying upfront?
So
because you're buying a right to purchase the stock at $108. You're not obligated to buy. You have a right to buy basically at 108 on 21st of February. For that purpose, you're paying a fees of 1.21 per share. Now,
okay.
because you're buying this right today, the guy is taking a risk. Tomorrow, your share goes to 120, 130, 140. Basically, you will be making huge profit. But if the share goes to $100 after the result or 95, your money lost is only 1.21.
Yes, okay. Basically, you're betting at that cost of 121, whether to gain or lose.
That's right. Very simple. Now somebody was selling a covered call also. No, I think probably I'll try to cover that in maybe in 2-3 minutes. Okay, imagine now the same Walmart stock. Imagine, okay, I'm going to tell you here. Oh, this is very interesting. Imagine I have a stock Walmart. That
But
means
first of all, what is covered call?
So I'm going to cover the covered call only. Okay, just so basically, first of all, all these strike price are in money and out of money. You all understood that basically, correct? Basically, that's what you know. This is all out of money strike price. This is all in money strike price for call options. I'm talking about. Now, I'm going to sell a covered call. When I'm going to sell a covered call, what does it mean? So imagine I have a stock of, and this is, follow this carefully. I have 1,000 stocks. I bought it 3 months before. I don't want to sell it. I definitely don't want to sell it. And don't want to pay the taxes. I will pay the taxes on a long term. So my goal is to keep the Walmart stock for more than 1 year. Okay, so what do I do? So next week, Walmart result is going to come. Maybe first thing first, when you're in option strategy, you need to start with your thought process. Maybe I'm expecting the Walmart share to go down to $100. Okay, but I don't want to sell the shares today. So what do I do? So what I'm going to do, I'm going to sell the call. I already have the shares. I'm going to sell this. I'm taking some risk. I'm going to sell the stock of 104 call price. So I'm just doing it at the current market price. So what I did is I said, okay, guys, on 21st of February, I'm ready to give my 1,000 stock at 104, and you pay me upfront 2.75. So what I'm doing is, for up to 21st of Feb, I got 1,000 into 2.75, that is 2,750 upfront money, basically. And the stock went down to $100, $99. I keep my shares and I keep this 2.75. That is how I have sold a covered call. So my goal was not to sell the share, earn the money upfront, basically in a short period of time. But my basic assumption is the price is going to go below 100 or 101. That was my basic assumption. Now, where I can go wrong in this strategy, I can go wrong if tomorrow the price goes to 108. I have to sell my stock at 104, but I also got 2.75. When I got 2.75, actually I sold my stock 104 plus 2.75, 106.75. So today I am taking 2.75 upfront commission to agree to sell the stock at 104. I already have a stock with me. So I can sell at 104, I can sell at 100, I can sell at 108, whatever I want to do it. It depends on, do you want to make a money out of the call? And if you want to make money out of the call, bet for something which will never be achieved. For example, sell a call of 115. You feel this will never achieve. This 26 paisa, it will be in my pocket. You can sell the 115 and this 26 paisa belongs to you for the next week. I was expecting that it's going to go to 100. If it's going to go to 100 and I don't want to sell it, maybe I'm ready to sell it at any price above 100 and earn this premium, whatever you see here. Basically, I'm not taking a risk to go to $100. I'm just saying, okay, 104, sell it, give me $2.75. So even though it goes to 100, I keep this money. Even if it goes above, I already made $2.75 upfront. That's called selling of a call when you have a stock in hand. That's called covered call sell. Sorry if I confuse any of you.
It's like lending your stocks for call options instead of the Robinhood.
You're not lending, you're actually hedging.
Not the
You're
actual
literally,
stock, but option.
yeah, but no. Because you're selling, understand, when you're selling a call option, you're pledging your share to Robinhood. You're telling Robinhood, take my stock from my account to your account, theoretically speaking, and you can sell those at 104, basically, if the share price goes above 104. If the share price does not go 104, Robinhood releases that to you on that Friday or whichever the date is, basically. And you can keep 2.75.
It is like, I think at this point we can explain the difference in covered and negged call sell. Okay, then it will be better.
Covered and naked.
Negged call sell. So
Uh,
let's say if
okay.
somebody's don't have the shares,
I know.
okay, and
Okay.
sold
Okay.
the calls
Okay.
for 104 to collect 2.75 premium,
Un-
but next
Understood.
day for the
Understood. Okay.
expiry date the stock goes to 120. Then
Yeah,
the person has to buy the stocks at 120 and sell at
yeah,
104.
we'll show. Okay. Anilji, understood what you're saying. So again, we'll continue the same example what Anil is saying. In this scenario, we had 1,000 stock in our account. That means an investment of $104,000. We bought this stock at $80, $90. We were anyway in a profit. So we really don't care whether it tomorrow goes to 110 or 100. We made our profit. We wanted to earn this premium and be done with it. But some people, without having stock, sell basically the stocks. So in those scenario, and I'm using Robinhood experience because I've been using Robinhood. Other can jump in if things are handled differently in the other platform. So if I'm selling for 2.75104 and the tomorrow the share price goes to say 120, what Anilji is saying. So when you sell this for 2.75, your equivalent money is going to get blocked by Robinhood. That means in an earlier scenario, what happened is you literally pledge your share at 104 to Robinhood. That means your investment of 104 was basically blocked with the Robinhood. Now, when you're selling without having a stock, Robinhood needs some assurance that you can buy the stock basically at that price, because you're selling a call option. When you're selling a call option, somebody's going to buy it at 104. So they are going to keep the equivalent money blocked from your cash bank balance, technically, which will not be available to you to play. And that's it. You can make 2.75, but in tomorrow, what happens if the price of that stock goes to say $110? You made $2.75, but you literally have to buy 1,000 share at 110 and complete your contract and come out of it. All you made is a 2.75 against it, but you literally made a losses, if you ask me, because it was your naked call. Naked call means what? You don't have a physical shares to pledge with the Robinhood, so you instead kept the cash with Robinhood. But if the share price goes up when you're selling it, it's your loss is unlimited. You can go anywhere. Imagine a GameStop scenario. Imagine a stock which rides overnight. Take an example of a last week. What happened with 2-3 stocks went up 23-25%. You try to sell for 50 cents, 20 cents, and it will be a disaster to see how the price goes up, and you will end up losing thousands of money. So that's what my recommendation. And as I said, you do your homework. Never sell calls. I always say that, whether it's a call option or a put option, don't sell it unless you are very good at the option strategy. Buy them, buy a call option or buy a put option. You can sell a call option when you have stocks, exactly what I showed. Then you have peace of mind because your loss is limited. Your worst case scenario, you're going to give away your stock. Give the stock and you keep 2.75. You still made a profit. You sold the stock at 106.75. This is 2.75 you made upfront, and 104 was the strike price on that day. So on 21st, you still realize 106.75 in your bank account. Doesn't matter where the stock goes.
Again, I think the disclaimer: if you are new, don't do options.
I completely agree with Anilji. My always recommendation is, and that's how I learned in the early investing back in 2003, 2004. We have been investing when we were living in the hostels, being a finance students. Options is to protect your investment. Always remember.
And one more thing is, don't play with options with margin account. Otherwise, that will be a double sword for you.
That's right. Never borrow the money for any investment, I would say. You can leverage it to some extent in a non-volatile stocks, but never leverage your account with the volatile stocks.
I
They
just
could
want
go.
to add on, please, for the new people, just to get a info about option, but do not do it unless you there's a lot of stuff to master it, you know. So
Yes,
the first
yes.
thing you just need to go with the long-term investment or either swing. So swing is much easier, you know, because you're making decision on the day candle, and which is there is no rocket science, you know. Just give a little bit time and you will master that skill. So once you master that skill, I think, you know, after few years, I mean, technically, if you go with it, around 5 years you need it, and 2 or 3 times you blow your account, so it's almost zero. Then you started to see the profit. All right, on the day trading side, I'm talking about.
Yeah,
So just like I agree with you guys, just do the swing, and then, you know. But it's good to have those knowledge about option and everything. But please don't do it directly. I know that if you have extra money, just give it to me, because I know you will gonna lose it. Thank you.
No, thank you, Dharma. Thank you for that note for sure, guys. I think that's very, very important.
Basic knowledge about options, and if you really want to do, you need to learn the Greeks and volatility, and yeah. So before you start doing options, you have to learn that as well.
I'm going to spend some 5 minutes if everyone has a time. I know we're overshoot by at least 8 minutes. We started late.
We are
I'm
good.
going to cover.
Some task to do, right? So,
Sorry.
I said we are good. Anit, I thought you have something to do at 9.
Yeah, Anil, I cancelled it. Okay.
Okay.
So Saloni went and she's picking my food. Okay, continue. So I'm going to cover a long call options. Okay, very long call options. How does people play on a long call option? Maybe take a Microsoft as an example. I'm coming back to the Microsoft again and again because we all are very familiar with the Microsoft. Now, if I want to go to the Microsoft stock, let me just go to the Microsoft stock. Everybody. What we are doing. Okay. As I said, options begins with our assumptions. Very important, correct? So take an example of 6 months journey of a Microsoft. In the 6 months journey, you would see the peak for Microsoft. And I'm going to go a little fast. Is like you can see the highest was, I think, if I'm not wrong, 467 or something like that. I see here 455. Okay, so yeah. Okay, so we are seeing a 455, which is what the highest is. Let me just see what's a 52-week high. Yeah, 468. So 468 is where the Microsoft went. Okay. Now, this was all at the P ratio of 33. And I think it's a separate concept, but I'm just trying to cover pretty quickly. So Microsoft basically announced, okay, they're going to make some CapEx investment and stuff like that. Price going down, 408. Now on this assumptions, now I'm going to go a long call. When I say long call, let's imagine basically a December of 2025. I don't want to invest in Microsoft right now, but I am certain I'm going to first make an assumption. My first assumption is I feel Microsoft will be 450 plus by end of December. That's my first assumption. That's a long call. So how much is an upside? 408 plus $42, that's 450. So $42 is what I expect the Microsoft would be by end of December. Okay, that's basically my assumption. Now I want to go to an option here. Let me just give you an option. I'm going to say, okay, if the price is going to go up, I go to the call option. Okay. When it's going to go up in December of basically, let's go to December of maybe 19 December is the last contract they have. So it's going to go to the 450. That's the least you're expecting. Because the Microsoft is 408, all this color is in money. So we need to go to a strike price, which is going to be more than that. I don't see it here. All strike price. Let me just go here, 450. So I'm expecting this to go to 450. So what I'm going to do is I'm going to make a call of, say, let's take an example of 420. I'm just going to put a price at 420. So, and the expiry is 19th February. Okay, got it. 420, 19 December. Is that right? Okay, let me just enter. This is still February. Sorry, I'm not able to see the strike price there. Not bad. Nothing's coming. I'm trying one more time. Give me a minute. I'm going to go to 19 December 2025. I'm going to go strike price of 420. All options. Yeah, it doesn't come. I don't know. It's showing, unfortunately, all the calls. Yeah, this is, no, I don't think so. Let me just see, 19th. Yes, this is the 19th. Yes, this is the one. Okay. Okay. Yeah. Where is this gone? It's not coming. Sorry, guys, it's not coming. I don't know, somehow it's not coming. I wanted to cover the long call, basically, particularly for Microsoft. But yeah, I think maybe in next session, Anil, we can cover with the Robinhood. That will be very helpful. This is not coming in. So long calls are basically in a stock like Microsoft, you are trying to
What are you trying
buy
to
a,
do? Sorry, do you want me to help you with anything?
yeah, you can, if somebody can open a screen and Microsoft and with a 19 December call, I want to show that scenario on a long call.
Let me try to do it. 19.
And
Okay, let me try to.
we'll stop
Okay.
sharing.
Yeah, let me try to. Okay. Share my screen.
And just go to Microsoft.
Can you see my screen?
Yes, we all can see your screen in the search. If you can put a Microsoft.
Okay. So
I can see there at the down in the right hand side.
Okay.
8th number
Yeah,
is
so
Microsoft. Just click to
it's
that
already
Microsoft.
Microsoft. So which you want me to go with strike?
Just click to Microsoft on right hand side. If you see the stock number was like 7 or 8.
I'm already in my Microsoft. So which strike you want to see it?
Now we cannot see your screen.
Oh,
I want to see 19th of December 2025. and take a call option of 450.
Okay, let's. Okay, now can you see it?
Yes, I can see it.
Okay, so which one you want me to do it?
450 strike price on 19th of December. Yeah, 19 December, just about that, yes, it has below that, exactly below that. No, that was
Yes.
September, just one below that. Yes, perfect. If you go to that, just go to the 450 strike price.
Yep.
Is that 450?
Yep.
And
Yeah,
can you double click and open? Yeah, it's a 450. Okay, so okay, let me see the price, which is high, low, and open. 23, 23.84, and 23.51. Okay, good. I think, can you just double click that? This one, can you double click it or no? That's okay. That's okay. Keep it like that. Just increase the size, and this is okay. So I want you to understand, everyone. I think just while you move the cursor, $450 strike price is what he's showing. If you can see that blue screen, in that 450 strike price, the current market price for Microsoft is 408. I personally feel the price can go to 450, 460. It may not go beyond that. That's my first assumption. So I'm really going to make a money of $42 by waiting for another 10 months and 15 days. So how do I increase my return? And I also feel that Microsoft could also go down to $380. So those are my two basic assumptions. So I feel maybe it can go to $380, and maybe it can go to $450. So first, when I assume that it can go to $450, instead of buying a call, I am selling the call. I am collecting an upfront $23. So what happens is you are pledging your stocks for 1 year and you are getting $23. Now think like this. This $23 and a current market price of 408 is actually Pachok V's 5.5%. So it's giving you a return of 5.5%. Assured that you are going to get $23 by end of December, no matter what. You're pledging your stocks, and your stocks will be sold at $450. So technically, on 31st of this is called long calls. Okay, when I'm not sure whether the Microsoft can go to 380 or it can go to 450, maybe I picked a price of 450 and I'm collecting a premium. I picked up $23, kept in my pocket, and what happens is, when I did this, tomorrow on 31st of December, 19th of December, imagine the Microsoft share price goes to 470. Even if it goes to 470, I actually making a money 23 plus 450. I will be giving my shares. I get $450 on 19th of December, and I already collected $23 upfront. So technically, I sold my share at $473. And why this worked out? The current price is 408. If I put this strategy, $23, I'm selling it 450 price. I'm technically going to sell at 473. So 408 minus 473, I actually made a profit of $65 on an investment of 408, which is actually equal to 15%. So today, if I want to make a 15% assured return, when I expect the price to go to 450 plus, maybe I'll sell the call of 19 December. These are long call. That's a one side. The share price goes up. Now, what's the second side? If the share price goes down to 380, then actually you're making a loss of 408 minus 380, which is $28. But by selling the call, you already got $23 upfront. So your loss is not $28, your loss is only $5. So with this strategy, you are protecting your downside up to $23, and you are collecting at least 5% of the return on a Microsoft stock, basically. So you're collecting 5 premium, protecting 5% downside, and upfront collecting the premium for 5%. But you are committing for a long period of time, which is till December. So in a volatile environment, when you expect the stock to remain range bound in 5%, probably this way you protected your downside, and you also basically collected upfront premium 5%. No worries. If tomorrow stock goes up, you're still making at least 16-17%. I don't know whether I made a sense to everyone. How does the long call strategy works, basically?
So this one was for the stocks that you already have, right?
That is right, Swati.
Okay, makes sense. Yeah.
Any questions on this one, like 450 strike? And because as I said, option is to be start with your thought. What do you think the market or a stock will perform, and accordingly you have a plenty of variety to play around, basically. Here I'm expecting I want to protect up to 380. Maybe I want to collect the premium till want to sell it by 450. That's what I expect. I don't expect the stock to go beyond 380. I don't expect that. And maybe I don't expect it to cross 480 plus. I feel it's going to range bound for $100 for at least 1 year, knowing the capex what these guys have announced. This is my thought, and I'm just using this as an example. This is not an advice. We're using this in a discussion purpose, but that's one of the strategy I could do. Okay, and then this in the same scenario, I can do one more scenario. If you expect the Microsoft stock to be $550 after 1 year on 19 December, 550. No, just keep it at 450. No, you don't move the screen. You are expecting that stock could go to 550. Maybe it's going to from 40, it's going to go to 550. So instead of buying the stock, I am buying a call option at $23 for 450. That means the stock is going to cost me 450 plus 23, which is 473. I will still make a profit of 550 minus 473, which is basically equal to $77 basically. So my investment is $23 and I made a profit of $77 because I am expecting the price to go up by 550 by end of December. So I took a long call. I put up strike price mid somewhere at 450. Current price is 408. I picked up a strike price of 450, paying 23 upfront. I'm not investing in a stock, just paid $23. If you buy 100 stock, you're only investing $2,300. If the price goes up beyond 473, because your actual cost is 450 plus cost of call you buy, 423, which is 450 plus 23, 473. So your real cost of purchase is 473. Your profit begins after 473. So if on December, if the price is above 473, you will start making money. And that's basically without having a stock. You're just buying an option, a call option, because you expect the price to go up. This is called long calls. You can sell the long calls and you can buy the long calls.
So first one you explained for the 450 was the selling long calls, and the one you just explained is the buying call, correct?
Correct. But in both, when I said sell the long call, you must have stock in your hand.
Correct.
And when you're just in the second scenario, when you're buying a call, you don't have a stock, you're just putting $23 in investment. You expect the price will be more than $473 and you will start making money on that.
So in the second scenario, you did not have your stocks actually. So what happens
right.
if the price goes down and you don't want to, goes very like up, you still will be paying at the max for 50 only, right? Plus the 23, whatever.
That is right.
Right.
That is right. Your max cost is 473.
And what if you don't want to buy that? So you are just losing $23?
That's
or
right.
You don't.
That's right.
Okay, that makes sense. Yeah, thank you.
Practically,
Yes.
what happens is nobody keeps the calls or puts till expiring, right? If it's a long, normal, right? They try to cash on the momentum. So whenever we get profit, we just close the contract and get out of it. Unless you're doing covered call, is different, right? But if somebody is buying calls or puts, just want to get out when they're in profit.
Yeah, you can based on the momentum. So for example, imagine both the scenario which what I was explaining, correct? So let's go with the second scenario first. You bought a call for $23. The current price is 408. You bought a call option for 450 strike price. And Anilji, I'm continuing your example. 2 months down the line, price is $450, $440. Imagine within 2 months itself is $440. This $23 price now it's going to be $33. I can tell you. So you don't want to wait till December, make $10, sell your call option, make a $10 out of it and come out of it. So you are catching the momentum as Anilji said. So when you are taking a long calls, you can catch up the momentum if it's the strike price, sorry, the share price goes up very fast. This $23 call is going to be expensive. You already bought it at cheaper rate, sell it and come out of it. The contract is closed.
Jiju, I have a question,
Mm.
especially for covered call. So suppose right now Microsoft is 408 and I am selling a covered call for 430 um, for and expiry is after 2 months like March end. And suppose it was 430 and after 1 month Microsoft is around 425, but my contract was with him like uh, for 420 or 430, right? So my contract was for 430 and it's going like 425, and I don't want to sell my those 100 contracts like that was the collateral for covered call. So can I close it because I have already sold? So how can I can close that
You have to
contract?
buy now because it will be expensive. Because you sold the call at 430 strike price when
Mm-hmm.
the current market price was 408.
Mm-hmm.
So what we call it as a spread was $22.
Mm-hmm.
In a spread of $22 with a 2 months left, very important, that's the cost of capital. Your cost of capital would be like, imagine you covered a premium of $4, Shubham.
Mm-hmm.
Okay, तुमने $4 कमा लिए suppose.
Mm-hmm.
But when you made a $4 upfront on the day zero, what
Mm-hmm.
was there? Current market price 408. Strike
408.
price 430.
Mm-hmm.
And that's a spread of $22.
Mm-hmm.
How much how many trading sessions? You're talking 6 trading sessions up to 31st of December. So 6 trading sessions, 22 spread, you collected $4.
Right.
Now imagine the price goes to 425, exactly what you just said, or 420
Mm-hmm.
after 2 trading session. So now the trading session reduced from 6 to 4, and the price increased from 40 to 420. So this $4, my guess is could be now $5.
Mm-hmm.
Now if you want to come out of it, you will have to buy that call as you sold it, incur a loss of $1 because you earlier you collected $4 premium. Now you have to pay $5 premium, incur a loss of $1, but you basically release your collateral.
Okay, so we can close it earlier if I'm seeing like it might skyrocket after 430. So I don't want to minimize my potential profit. So in that case, I
Perfect.
can close
Perfect.
it
Perfect.
early. Just
Perfect.
I have to look at what's the call buying price at that time, and I have
That
to
is right. That's going to be
buy
your
it.
loss. That's
Okay.
right. But do that decision before it becomes in money. Because the moment
Mhm.
it's going to cross 430, you are basically going to pay so much of the money, which is basically a risk. I would rather keep it unless you
Yeah.
expect stock price to go up. Because देखो 430 plus 4 rupees, तो 434 तो तुमने कमा ही लिया
Right.
मार्च तक. 434 के ऊपर जाएगा, then only you would take that step what you're explaining. Otherwise you will not take that step.
Right. So ये सारा कॉल पुट और कवर्ड कॉल में लाइक सबसे सेफेस्ट बेट मेरे को कवर्ड कॉल ही लग रही है. बस हमें कोलेटरल रखना पड़ेगा.
So एक और इसमें ऑप्शन है, because when the price goes up significantly, right? And you don't want to sell or you don't want to lose the potential profit, right? Which you can see is
Right.
coming. You can do the rollover for the
Another
covered call. You can buy that call at the same time and sell another call for next expiry, maybe like 1 month after the current one.
With the same collateral, or we'll need the different
Yeah,
collateral?
those same collateral, but Shubham, that there, Anilji, you would actually spend more money Rather, what you can do it is, for example, in this Shubham case, if he's expecting the price to go to 450, let him buy another call instead of basically he sold the call. So buying the same call, buy another strike price call. You will make more money if you're so sure.
Right, but nobody's sure.
Because in renewals,
What I do normally is, let's say, I will go for a future call and higher strike price. Okay, so I may end up collecting the same premium, or maybe not, because when we have more time, you still have the time value in the call, right? So let's say the current call is expiring this week, and I will sell another call for 2 weeks after this, so that will have more value, okay, than this one. So I will still collect
So
more
Bhaiya,
premium.
Anil Bhaiya, when you are selling another call, then you need like another 100 stocks.
No,
No,
you're
no, no, no.
buying
You're
this one,
renewing,
selling
na?
that other one. So you are just rollover. It's
Yeah.
called rollover.
Okay.
It's like it's Shubham.
In
Whether
rollover,
you
we just pay the difference, right? Or
yeah,
we
no,
Depends
no. So Shubham,
what strike price you choose. It you may collect more premium, or you may pay, or you may close at same price. So I normally go for higher
okay,
price if I'm expecting the stock to
let
be
me
higher.
simplify for you, Shubham.
Mhm,
Whatever I told you, it's
mhm,
exactly same. So instead of what you're doing is you sold the call, now you're going to buy the call, incur 1 rupees of loss,
mhm.
and then instead of now 430, you're going to sell 450's call. Then you'll collect another $2 premium. You see what
Okay.
I'm saying?
Yeah,
So
yeah.
what Anish is saying, initially you collected a $4 premium, then you paid a $5. So your cost was $1.
Mhm.
Then now you sell another 450 to strike price, collect another $2 premium. So essentially you collected only $1 premium. But now the upside is 450. So you technically you're selling the stock by 31st March by 451 plus. अब 451 के ऊपर जाएगा तो तुम्हारा loss है फिर. That's
ओके
what he's
सो
saying. So
सपोज करो लाइक हमने $1 का खरीदा था, लाइक हमें $1 प्रीमियम मिला था, और अब रोल करने के लिए मेरे को इसको वापस खरीदना भी पड़ेगा, तो सपोज करो वो $1 और बढ़ गया है, तो
वो
$2 हो
$2.
गया, और फिर हम रोल कर रहे हैं, तो वो बाद में अगेन मेरे को अगर $3 मिलने थे उसके, तो वो डिफरेंस उससे घट जाएगा और मेरा
Yeah.
रोल हो जाएगा.
Whether you do the
Like
rollover or you
I'm
do
closing one
separate
position
transaction,
and opening
doesn't
another.
matter.
Rolling is just similar to that.
Yeah,
It's
rolling करना और square off separately करना is also one and the same, because system does the same thing. Only thing is when you do a concept of rollover, they are doing exactly at that fraction of second. Both the contacts exactly same time, basically.
God.
That's it. Otherwise, they are
Yeah.
two independent transactions.
Yeah, मैंने only call buy का rollover किया है, but covered call like I'll try for the first
You
time,
can
so
do
that's why I
rollover
was
for
asking.
anything, but
Mhm.
yeah, this is just how system works.
Okay, got it. Thank you, Jiju.
See, volatility matters when results are there. What is the spread? What is the trading session? What's the volatility street is expecting? So, and accordingly, the premiums are very, very different. You know, when we talk about strategy next time in the session, I'll show you how I have 3 buckets of stock which are highly volatile, medium volatile, and maybe very low volatile. Low volatile stocks are like banking stocks. Medium volatile stocks are like a Microsoft or these stocks, and low volatile stocks are like a Johnson and Johnson, or maybe say Walmart, or maybe Rethon Technologies. These are the low volatile stocks. So
Apple.
Apple is basically it's very difficult to establish a trend, because after 3 years of a stagnant journey between 140 to 170, it has only shown a trend of last 12 months. Okay,
Mhm.
basically from 170 to almost to 230 to 40, whatever we see it. So I don't see Apple is a very volatile stock. It will remain in the mid segment where the Microsoft is right now, basically.
Okay.
Correct. So non-volatile stocks, very easy to make premium on a weekly basis. I generally do that with the say Bank of America or Johnson and Johnson or Rethon Technology. You can easily make 2%, 3% on a weekly basis. The volatility is very low. That means the stock downside is very less. I'm giving 3 examples, and you can, and how to compare what the volatility factor is. Take a price in your mind, $100. Pick
Hmm.
up 3 stocks of same price. Walmart देखोगे तो भी 104 के आसपास है. Johnson and Johnson देखोगे तो 140 to 150 के आसपास है basically. So
Hmm.
if you see, and Bank of America देखोगे तो 45 रुपए का Bank of America है, ठीक है? So imagine when you collect a premium on Bank of America versus Walmart versus Johnson & Johnson, you can see how much percentage of premium you collected. And you will be surprised to see the game basically कि कैसे होता है on these non-volatile stock. Sometimes you really make a good money where your downside is very nicely protected. ये जो mid वाली और high वाली है, big stock, high volatile stock like a Tesla or Nvidia or those things, very risky to play on the calls or the puts for matter. It's like it can go either way. You can be on a benefit side or you can be on a losing side. So if you want to earn the commissions, like you are saying, sell
Mhm.
covered call, sell covered call, my recommendation would be to touch those stocks which are very less volatile.
Okay. And it also depends like stock to stock if you want to like have the premium for weekly or monthly basis.
That is true, but in a non-volatile stock, whether you are buying weekly or 2 week or 3 week, it doesn't matter. It's going to go in line with what the 10 years bond is or 5 years bond is. That's how they work because they're
Mhm.
non-volatile. Honestly, if you ask me, it's a very complex calculation how the system does. You really have to catch it very quickly. But I understand it back of my mind because always it's a cost of capital with the timing and the spread and volatility. 3 factors drives everything. I don't understand alpha, delta, and all those things, but more or less alpha, delta also explain the same thing. I never understood that, but my quick maths is always the volatility factor, what's the spread, and what's the timeline, and what's the cost of capital right now in the market.
I
Okay.
think the simple way, if you want to understand the volatility, just like a simple, very simple way. It's just any stock you just check the yearly return. What's the return is there, and you can divide whatever the trading days or whatever 365. So each day you can fill it. Like what's the volatility? Like some of the stock like Walmart or I got the program which see the volatility, how much go up or down or anything. It's just general scenario, so you can get an idea. What you expect. Some stock like what you're saying, Walmart, but if you expect it will go 30%, it's unrealistic. So that's what you need to the check the volatility. And if someone want to check, I'm happy to do it, and I will share something so you can understand. Might be what's just not brief, but just so you guys can understand how volatility do work in the system. Let me just 1 minute. Okay. But this is totally for day trade, so but you can get an idea. Okay, let's see, where is it? History. That's fine. Sorry guys, just look. What's this thing? That idea. This is the one. Okay, why not? Just to brief, if you can say it, you don't need to think about too much, but just whenever the green part is there and these two lines are there, volatility is increasing and decreasing. This is for SPY, but if I put it on the day chart, you can see it, and especially you're doing for long term, so you just go by weekly. So yeah, it's basically you can generally when increasing or decreasing or what it does do. So
Can you
yeah,
just to show 3 stocks so that they understand? I'll give you, instead of SPY, just use maybe a Bank of America, and then we're going to take the next stock.
what's the ticker?
BOA.
BOA.
No, I think is that no. I think the maybe what is the Bank of America sticker? Let me
BAC,
just
BAC.
BEC. Okay, sorry, my bad. Thank you, Anil.
See. Okay, so it's weekly chart. So generally, if you do so you can also use a ATR to do that one. But generally, whenever the green is there, the volatility is increasing. Whenever the red is there, it's little bit decreasing, but just when it's increasing, you can say it's come with, and this based on the German class volatility. So that's the bit advanced model to do it. But one of the things I want to show it. I mean, I would overtake it, but just leave it this one, so people can understand how things work. So volatility is very important part. All right, you carry on with these things.
You can just show one more stock there. Carvana. Just show
Okay.
Carvana.
Okay.
Just
If you want to see it, let me get a hard rock data, so you will understand. Just give me just a minute.
yeah.
So
Sure.
I can, so you guys can understand. Let me go to the, so which stock you told me? The BOE, isn't it?
No, CVNA. Just look at CVNA.
Okay, let me try to edit. Sorry,
CVNA.
Okay, and what's the other one? BOE.
The Bank of America, you mean?
Yeah. And what's the other one you was talking about?
Bank of America is basically BAC. BAC.
Okay, let's two. So you can see my screen, isn't it now? Which you seeing the chart, or what you are?
We do see the chart, but nothing has changed since.
Okay, let me change that one. So that's how I do it. Sorry. Settings. Sorry, too many screens are there. I don't know which one is what, but okay, yeah, found it. Okay, so let's look for the BOC. Yeah, so the current ticker BOC, it's $15, isn't it? Price. Hello.
No, BAC. It's a BAC.
Okay, so, just because I need to change the program. Anyhow, CVNA, it's 285 is the closing price. So the mean volatility is, 70, 0.75. So, you expect, I'm talking about daily, average. The highest, the highest is, 10%. 10%, like it's based on the daily, but if you want to do the weekly, weekly is, almost the mean is, 1.72. Weekly can go up and down. So yeah.
Shubham, put on a mute.
Oh, sorry. मैं दूसरे रूम में हूँ लेकिन I didn't know I am not.
Yeah. So yeah, that's how volatility works. You
Now,
get idea?
same show the same percentage on a weekly for Bank of America, BSC.
Yeah. So
Remember,
this is the Bank of America. Okay, BAC. BAC. Let me try to do it. BAC. Yeah,
instead
so
of week,
you want
just do weekly. Yep.
Okay. So weekly we have a like a 0.29. So you're right. So that's the volatility we have.
Yeah.
Yeah. So you expect like if something happen, big one. I mean, the larger case can go 9.92% up and down. Larger case, but it's very highly unlikely to happen. Because if you can see it here, the most of time price here within. The most of time, the price within 2 sigma band. So, it's just the program. So 98% of the time, the price is staying between those two band. So, yeah.
Yeah. So basically, and those 9%, what you see in the upper bound sigma and all those things for Carvana were like 15, 30, 35%, because these stock price basically are like a balloon. They are just growing. Either they have the fundamental, they don't have fundamental. Their PE could be going extremely high without underlying valuations. And this could be either direction. They are going to up, or they're going down, or they're going to up and down. But the movement is very high, and you can tell that from a graph. And that's what I call them as a very volatile stock, while he explained it so well on the technical side with the help of Sigma. But my recommendation is, when you play on a call options and put options on those high volatile stock, you are going to lose money, because the premiums are so expensive. The premiums are going to get diluted, and you would be mostly losing money, and that's it, nothing else, if you ask me. So your best bet to sell the call and earn the premium is a non-volatile stocks always.
Look at the Tesla. It's 1.2. Like a volatility. It's huge. 1.2% can go up and down. So
and Dharma, this is only when you're looking at weekly. The moment you shift this post-election and cover a period of like maybe 12 to 16 trading session, this could go drastically up, because we have seen Tesla has gone from 142 somewhere to like, we all know the price 350, 400. I don't know. So
yeah, after election from 250 to 450.
correct. So that volatility chart is going to show so different. Right now on a weekly itself, what he's explaining is 1.21 is very high.
Yeah, any stock, 1.2. I mean, technically, if you think about the reality, I mean, 1.2% means like yearly, if you count, it's almost, how much, 25 or calculator.
No, weekly to 52 weeks ho gaya na. The 1.21, if it's weekly, that's going to be very high, basically.
Yeah. So you basically, if you do the 52, you know,
You're talking
like
about
62%.
62, 63. Yeah, 60
Yeah.
to 60%. Yeah.
So it's too much to handle, and especially,
Yes.
you know, as a new person, you know,
Yes.
like you will cut your throat, you know, easily.
Yes,
I mean,
absolutely.
even though I'm not a master, but I know a little bit technical, but sometimes it's not possible. I scratch my head, you know, what the hell happening, you know? Because, yeah, it's, yeah.
I'm a very value investors, very big time value investor. I would tell that I want everybody to understand basically where you will not go wrong is concept of a PE. What price earning ratio stands for, which industry has what. Maybe some other day we cover, Anil, the what's the price earning ratio, how do you read it for a banking industry versus a staple versus basically an auto or retail. How does the PE looks like, and those are your best indicator to buy and sell the shares, honestly. When I talk about FANG group, which is Facebook, Apple, and all those things, yeah, any PE about 30 is very, very expensive, in a traditional finance basis, I'm telling you. Basically, if you look at all our company back in India, Infosys, TCS, Wipro, HCL, Tech Mahindra, IT company, they all get valued from 18p to 25p. That means what? They're valued 25 times. Like Microsoft is valued right now 33, 34. Forward P is very different. So while if you look at Toyota shares are not Toyota, Ford, they are valued at 9 or 8p. If you look at bank stocks, they are valued like 12, 13. If you look at airline stocks, which is basic, they are valued at 7, 6. Cruise stocks very differently. But some stocks like Tesla, you could see the PE could be like 100. Carvana, it could be 120, 150. I don't know. It doesn't fit into financial world. If whatever concept we learn as a tradition, the valuation doesn't justify. Never justify. So when you are beginning in the stock, your value investing is the best bet. Always the best bet.
If you see the recently PL, you know, TR, I think around 600%, you know, the PE ratio is there, you know, and
Yeah.
people keep on buying. I mean, just check the Heathis, because Sprint, what you call this Trend Spider, there is one software, same as the Trading View, and they have one of the indicator which is based on the PE ratio. If I would, you know, find somewhere, I would happy to send it, so at least you can, you know, get an idea, you know, what's happening. And I think it is अगर दूसरी बार तुम, you know, financial side का एक seminar किया तो बहुत अच्छा रहेगा. You know,
No
I
problem.
don't know much at all. You know, like financial side, I that's my weakness. I don't know anything, but most of my skill is technical side. I don't see financial, but it's suited to me because I just do the day trade, you know. So
Yeah, no, and I
but
get it. I'm completely with the piece. I don't invest where I don't understand. That's my basic rule. If I don't understand that company, how that go, even though I understand, I don't understand fully, I never invest. For example, Tesla, I never invested. I never understand the valuations and everything. Maybe it's right or wrong, I will not debate. But crypto, I never understood how does the valuation work. A $1 printed a $1 on piece of paper is $1. It cannot be sold for $2 or $3. Like gold can be sold, but how does a crypto? So it's a very different concept. But I don't understand, I don't invest. Basically, very simple.
That's the best way, you know. Look, you know, and I think most of our group people need to, I think, best if they can, you know, do the you know, like a follow your style is much better, you know, compared to we all are punters, you know, like whatever you see in the group. I mean, it's look rosy and everything, but you need to spend that years and years to learn that, you know, so many things. Yeah.
Okay, but yeah, I think just look at. I think we should do one PE concept and what's the value investing, what the industries are, what's a staple, what's an auto, what's a finance industry, and we can go through with the normal PE versus a forward PE. What's the rule of 40? The rule of 40 is the 20% EBITDA and 20% growth. That's how the private equity operates at. how does the rule of 40 works? If the rule of 40 is operating, what's the P you can
Yes.
give it to it, and
Yes.
all those things are very valuation models, what we operate in finance.
Like while we are talking, I think it's good to have I don't know how the system work, but if you couple of guys, like let's say actually share your portfolio or, whatever you buy, so we can actually, for a new people, at least they can do copy trade. Something like, we can work it out as a group. So everyone, use their expertise, but for a new person, it's hard for them to, directly, they will gonna, I mean,
maybe, and one of the idea could be like people can put like, okay, I'm investing for stock. What's my thought is, I think we can put a baskets of stocks and thought process of people, and then we can brainstorm around it, and maybe bring a common factor, correct? Because one of the common factors is going to be a growth, or one of the common factor could be like you guys are just following the graph or the news, something like that. That you won't be surprised, basically.
Yeah, I think it's best idea for, this is the where group come, that's what last time also I told, we are so intelligent, but we are so idiot, because we don't want to spend too much time on these things. And as a group, everyone has a skill, we can do much better as a group if we, like, this is all about swing, as a swing, everyone invest and everyone, come to the one point. It's
You're right, but I think sometime, I will tell you, having too much knowledge of finance also does not help, because you go into too much analysis sometime and you really lose the momentum. And I've seen that particularly in many of our case colleagues, and I've seen people who don't understand finance and they do value investing and just keep waiting. They really make good money as well. But I'll tell you one simple example, and sorry if I'm taking time. I asked my son, and when I was teaching him maybe 4 or 5 years back, what the stocks and everything, and how the valuation works and how the market, and he told me, "Pa, just go and buy Nvidia. Don't do anything. They will be just leading this world. Their GPUs are going to, nobody's going to beat their GPU." And this is what I'm talking about in COVID era, when my son was telling me, "Pa, just don't invest anywhere. Just invest in Nvidia and be done with it." I was like, oh wow, I wish I would have thought about it. So what I'm saying is, apart from that finance, somebody who's in technology, and there are so many people on technical side who knows, okay, I'm using Palo Alto, and one of my guy who's a practice head in Wipro, basically saying, oh, the security products are amazing. We are still using it. How they are being leveraged, those technology. You look at like an Nvidia. One of my sister's son is in a gaming company, and he told me a couple of gaming companies. They said, Hitesh, they are going to be leader. They are monopolistic. This is what it is, and those insights are also helpful for us to really understand where the industry is moving. All we know is what we hear in the news, but these things become so important. How the company can exponentially grow.
That's what I'm telling you this, because we have a large group of intelligent people together, So it's sometimes you go in that silo of your mind where, you just focus on the, Bank of America, let's say, just the example. So, as a group, if you share those knowledge, it could be a better investing for everyone, isn't it?
Yeah, true. Yeah, okay. I think this 10 o'clock, if anyone has any question, maybe Anil, we can follow up, and we can decide what the next topic. And if you have certain thing to be still learn on call and put option, we can still continue. If anybody has any question there, feel free to chat with me. At least I'll be more than happy to at least direct. No issues at all. Just text me and we can agree on time, and maybe I can spend some time to direct specific question you may have. Okay.
Thank you, Hitesh bhai.